You've heard this before. Miss the best days in the market and your returns drop down very sharply. But what if I told you that it is only half the story? Research shows that missing the best 50 days could bring down your CAGR from 15% down to 2.4%. But here's what, that's only half the truth. The other half of the story, that the best days often come right after the worst days. The best and the worst days are clustered together. So if someone says that you have missed the 10 best days or 50 days in the market, you may counter that you have also avoided the most brutal market fall as well. So rather than worrying about missing the best recovery days, an investor should focus on minimizing the losses, which in the long term often leads to better performance than simply riding out the highs and lows of the market. What if instead of trying to capture every market high, you avoided the worst dips and aimed for a smoother ride, a portfolio that reduces volatility based on the past tests have earned 12 to 14% annualized over time without the roller coaster of the best and the worst days. So instead of fearing missing the best days in the market, focus on steady, consistent strategy. But here's where it gets a bit tricky. While missing the best days can hurt, that reality is that most investors aren't wired to stay calm during a market crash. And because of this, many end up missing the best recovery days, often out of fear and not strategy. Let me explain this with this very famous example. Imagine your financial advisor calls you with a good news that you have gained 1 lakh rupees. You are very happy but you're calm. Now imagine the same call, but this time you have lost 1 lakh rupees. Suddenly it is panic mode. This is because the pain of losing money is far stronger than the joy of gaining it. This is biology. This is why investors often pull out when the markets crash, even though they know that staying invested for the long term benefits them. Avoiding further pain makes them accept immediate losses rather than hold on for future gains. Why do so many investors sell at the worst possible time? It's not just bad timing, it's brain wiring. Our brains are wired to avoid loss more than they are there to seek out gains. So chances are that even in the future, majority of investors will sell out at the slightest doubt of market correction, trying to avoid the worst days. In the process, they are bound to miss the best recovery days too. Fear, anxiety, regret, these emotions lead to impulsive decisions to sell. Everyone knows the market eventually recovers from every crash, but in that moment, the fear of further loss dominates potential future gains. You are not a rational thinker anymore. That is why the legendary investor said, every past correction seemed like an opportunity, but any future correction is considered a risk. Another reason for this reaction is that many investors unintentionally set themselves up for disappointment. Recently, an investor asked me to review his portfolio, and looking at it, any experienced advisor would have suggested that he book profits long back. But now, the same investor wants to put more money into these funds right when they are at their peak. The truth is, the best time to invest in these funds was when they were underperforming, not now at their highest performance. Unfortunately, this kind of behavior is very typical of retail investors. They tend to do exactly the opposite of what they are supposed to. Today, these funds are the top performers. They are overheated. So the basic logic tells us to avoid overheated stocks and funds because they tend to take the hardest hit during a market crash. But again, this is psychological. FOMO, the fear of missing out. Most investors chase the best performing fund, not realizing that they are at times overvalued, and this behavior adds more risk to your portfolio than doing any good. So the solution to this problem is to manage behavioral triggers and pre-commitment. Let's break this down into 4 actionable steps. The first, automate your investments. Use SIPs and STPs to invest regularly without reacting to market ups and downs. Stick to time-based goals for your investments so you stay focused on the long term, not the short-term noise. 2. Set rebalancing rules. When your portfolio returns exceed a threshold that you set for yourself, for example, it could be 14% or 18%, as the case deemed fit for you, you rebalance and reduce the equity portion of the portfolio to lock in the gains. An old IDFC mutual fund research puts it well. When the recent returns are strong, say 25% gain in the past 1 year, future returns tend to drop to single digits in the following years. Conversely, when the past returns are low or even negative, like after a market correction of say minus 15%, then the following years bring strong returns. This is based on backtested data using rolling 1-year returns over a 20-year period. This is only probabilistic guide for investors, and to extrapolate this into the future means you're assuming certain GDP growth and inflation being under control, etc. Third, monitor equity allocation. Set your portfolio's equity allocation based on your risk profile or a risk score. Let's say your risk score allocates 60% to equity for your risk profile. So if the market gains pushes the equity portion of the portfolio higher to say 70%, rebalance and bring down the equity in the portfolio back to the original target of say 60%. This ensures your portfolio stays aligned with your risk tolerance. Fourth, choose funds with downside protection. Consider funds such as Balance Advantage, multi-asset funds, equity savings funds, regular saving funds for smoother returns in volatile markets, especially when the valuations are very high. Using framework and process such as these will avoid accidents, as it happened in 2020 when a lot of investors went chasing very high returns in debt funds, credit risk funds, and then there was this accident that happened in April 2020. So the real win isn't capturing every market high, it's finding a plan that lets you sleep at night. Avoid the big mistakes. If you reduce your exposure to those big losses, you will stay the course, and that's when the steady returns start compounding in your favor. If you are interested in receiving an approach paper to framework-based investing, feel free to reach out on this email ID. This video is based on my personal insights and should not be taken as professional financial advice. Please make sure to read the disclaimers before investing, and before you make any decisions, consult your financial advisor. If you enjoyed the content of this video, don't forget to like, subscribe and share it with your friends who might find this helpful. Your support helps create more valuable content.